turbulent and investors continue to seek for a safe haven to secure their chips. The good news is we have identified a rising star in the semiconductor industry. Ladies and gentlemen, we present you a promising investment opportunity to buy a company with sound fundamentals and excellent prospects. We issue a buy call on Inari Amertron Berhad with a target price of 4.29 ringgit, bringing an upside potential of 35% from a share price of 3.17 in February 15. Our recommendation is mainly driven by strong earnings growth. Besides, there are further upside from strong business opportunity ahead and better dividend payout. We begin with an overview of the company. Inari is in the electronic manufacturing services sector. It mainly provides back-end servicing of RF chip, also known as the RF segment. Besides, it manufactures optoelectronics and fiber optic products. 70% of Inari earnings come from the RF segment, in which our technology is a main client. Our is a leading designer of RF chip globally. Its FBAR filter is widely used by world giants such as Apple and Samsung to improve smartphone performance. Our sets its chip for Inari to assemble, package, and test. These chips are ultimately used in smartphones to transmit mobile data. Also, our is a key client in the optoelectronic and fiber optic chip fabrication. Moving on to financial analysis, we expect Inari to continue its stellar earnings performance. Earnings grow at a CAGR of 17%. Looking at the waterfall chart, the net increase of 177 million in earnings is attributed to three key factors: sustainable organic growth, margin improvement, and lastly, ringgit depreciation. Looking at the first driver, Inari is experiencing sustainable organic growth and is expected to contribute 105 million in earnings. This is sustained by our expansion and growing industry demand. Looking at the high margin RF segment, it continues to grow aggressively as the number of test handlers expanded 53% in FY16 alone. This is in line with our goal's growth, as our goal is targeting to double its capacity by October 2016. With the removal of our goal's production constraint, we expect other smartphone makers such as Huawei and Xiaomi to use FBAR filter in the future. This translates to more chip success at a CAGR of 16%. In other words, Inari rides along the way with its market-leading client in capturing greater market share. These expansions are also backed by the substantial increase in mobile data usage, in which 4G occupies an increasingly larger portion of the connection from current 40% to 70% in FY20. Hence, there will be increased demand for chips that are well designed, and smartphone may contain more chips. Next, I'll pass to my colleague Pei Hua to guide you through the other earnings driver.
Thank you, Jin. Second, we expect Inari's profit margins to improve, and this contributes to an additional earnings of 39 million. This is due to a synergistic benefits of its Amertron acquisition. Since the acquisition, Amertron's margin has improved from 2% to 6%. The synergistic benefits come from the group procurement of raw material, exchange of technical know-how, and R&D between subsidiaries. We believe that the profit margins will continue to improve as the other smaller subsidiaries continue to grow and reap the benefits further. Third, the ringgit depreciation adds another 52 million to Inari's earnings over the next 5 years. To clarify, 95% of Inari's revenue is denominated in USD, but only half of its cost is in USD. We believe that the average exchange rate will be higher than 4.2 ringgit per USD compared to 3.45 in FY15. These assumptions are supported by the depressed commodities market and domestic challenges. All in all, the impact of these three drivers is reduced by 19 million through a slight drop in average selling price. This is due to the volume discount given to Avago as Inari shares the gain from ringgit depreciation with Avago. On the brighter side, this may be overstated, as ASP may rise due to the sophistication in the chip design. As 4G continues to develop, the spectrum gets more congested and the chip may require more filters. More filters per chip will require longer testing time and thus increase the ASP. Moving on from the quantifiable growth, we identified great business opportunities ahead for Inari that are factored in the waterfall chart. These opportunities from Osram and Broadcom are expected to bring further upside to Inari's earnings. Firstly, the mega mergers of Avago and Broadcom favors Inari. While Avago leads in the RF segment, Broadcom is a key manufacturer of other types of chip, such as Wi-Fi and Bluetooth. The merger is the largest in the industry, and we expect more associate opportunities for Inari as its strong ties with Avago. Secondly, Osram, a key client in the optoelectronics segment, invested heavily to open the largest LED plant in Kulim. This will complement Inari's value chain and business. It is likely that the vacant Batukam plant will cater for Osram due to its strategic locations and business relationship. From the above opportunities, we believe that in Inari could set out new business operation with its strong cash base and healthy cash flow. Inari is capable of funding its capex without incurring huge financing costs. Besides, Inari is financially prepared for any mergers and acquisitions opportunity. Another reason to buy Inari is better dividend payout. Its cash base favors more generous dividend payout, and we expect the payout ratio to increase from 40% to 50%, generating greater return to shareholders on top of capital gain. Next, I would like to pass to my colleague Derek to talk about valuation.
Thank you, Berhad. We look at the valuation of Inari Amertron stock. We use two stages to justify price to earning ratio so as to reduce the impact of industry cyclical nature. This method considers Inari's fundamentals such as ROE, cost for equity, and sustainable growth rate. There are two growth stages. First, strong growth in the first forecasted 5 years. Second, moderate growth after FY20 upon completion of new operation. In the first stage, the value are based on our high growth rate assumption. In the second stage, we derive a COE of 9.4% with lower beta. Long-term ROE is on par with major peers in mature space like SE. Long-term growth rate is based on the IDC forecast on the semiconductor industry. Based on our valuation method, we get our justified PE of 18 times with the fully diluted EPS of 24 cents. We derive our target price of 4 ringgit 29 cents. To have a sanity check, we compare Inari with both local and international peers. After selecting Inari peers based on similar businesses and end-user markets, we have an average PE of 16 times. Inari higher PE of 18 times is justified given its strong track record and outlook in earnings. In fact, Inari has the highest profit margin and ROE among its peers. To evaluate investment risk, we conduct a two-way sensitivity analysis based on long-term ROE and growth rate, with a more conservative outlook in the second stage to acknowledge the fast-paced development in the industry. However, we believe the long-term growth rate is unlikely to go below 3% given the strong growth prospect of communication sector. This is further supported by the Monte Carlo simulations of both long and short-term growth rate. Through our simulations, we have approximately 70% incidences of buy call and less than 1% sell call. Looking at the risk metric, we focus on two key risks with high probability and high impact, which are exchange rate risk and competition risk. Inari is exposed to exchange rate fluctuation as 95% of its sales are USD. Inari may face compressing profit margin should the ringgit appreciate. For every 5 cent appreciation of ringgit, the earnings is reduced by 3%, assuming all things be equal. Nevertheless, the chances are low for our assumed rate of 4.2 ringgit per USD in FY16 to appreciate, given the current bearish sentiment in Malaysia. On the other hand, Inari faces intense competition in the fragmented market as companies with huge scale such as ASE and UNICEF offer similar services. This may cause Avago to switch contractor and Inari's utilization rate will drop. In our analysis, the utilization rate has dropped to 66% to change our recommendation to sell. However, we believe Inari has a low cost advantage and strong relationship with Avago to maintain high utilization rate of 85%.
To conclude, strong earnings growth in the RF segment, further upside from Broadcom and Osham, and higher dividend payout reiterate our buy recommendation on Inari Amertron with a target price of 4.29, bringing an upside of 30%. Ladies and gentlemen, place your chip in the rising star and buy Inari. Thank you.